What's up guys, Jake here. In this video, we're going to talk about Treasury yields because this is potentially one of the most important factors to understanding the stock market that 99% of people don't understand. And if you ever read articles or watch news coverage of the stock market, they will frequently mention Treasury yields. So if you go on CNBC's website, they got these tickers for the Dow Jones, the S&P, the NASDAQ, the VIX maybe if you're interested in volatility. But if you click on bonds, it talks about the US 10-year Treasury yield rate of 1.305%. What does that mean? What does it mean when it goes up? What does it mean when it goes down? And what is happening right now with the Federal Reserve controlling those yield interest rates? If you want to see the long-term chart on Yahoo Finance, you can do the hat symbol TNX for the 10-year Treasury yield percentage. And we'll click on max to kind of get a broad picture of what this thing has done over time. The data goes all the way back to 1962, and the right-hand column here is percentages. So 5%, 7.5, 10, 15. So if you wanted to earn, this thing got as high as 15.68%. If you wanted to get a guaranteed 15.68% on your money every year for 10 years, you could have bought US Treasuries in September of 1981. Now, the Treasury yield rate has been going down dramatically since then. So let's go to the 5-year chart, and this recently got as high as 3.21, but with the pandemic, it has dropped as low as 0.53. So if you want to earn 0.53% on your money every year for 10 years, you could have been buying US Treasuries in July of 2020. And before we explain the yield rate and what determines it, let's first think about US government debt. Anytime the government spends money it doesn't have, it has to issue debt. And there's a really cool website, usdebtclock.org. It's tracking the United States national debt. We currently have a US national debt of $28 trillion, and that's debt that had to be issued in the form of bonds, of government debt. Now, how big is this relative to the stock market? Think about this. The S&P 500, its current number is 4,436. For those who didn't know, that's an aggregate sum of the market cap of the 500 largest companies in America. And this stands for 44 trillion. So US government debt is 28 trillion and the S&P 500 is worth 44 trillion, just to put it in perspective. The total bond market with state and municipal bonds as well as corporate bonds, the total for the entire US bond market is about 46 trillion. And to finally understand US Treasury yields and why they're so low right now, we have to understand the difference and the importance of the Federal Reserve and the Treasury Department. The Treasury Department, I feel like, is pretty easy to understand. They are the agency of the government that is in charge of finding the money and issuing the money when Congress appropriates it. The Federal Reserve is supposed to be an independent entity. The reason why is because if one political party or person was in power, it'd be really easy to abuse the system if they could just print their own money. So the Federal Reserve is supposed to be an independent agency in charge of printing the money so that one person or one political party can abuse it in the short term. And I think we've all seen this hilarious meme of Federal Reserve Chairman Jerome Powell going brr with a money printer. Pretty hilarious. But how exactly is, right now, the Federal Reserve printing money? And the Federal Reserve, to control the money supply, has two tools available to them. Two primary tools anyways. So the first tool available to them is the federal interest rate. This is the rate that commercial banks borrow money from the Federal Reserve in order to issue loans, car loans, auto loans, small business loans, mortgages. And the Federal Reserve interest rate recently got as high as almost 7%. So if you were applying for a home mortgage in the mid-2000s, you would have had to pay this federal interest rate plus a couple extra percentage points so the bank can make a profit. We had the 2000 dot-com crash. The Federal Reserve lowered the rate basically to 1%. In 2004, it started going up again, got above 5%, and then boom, we had the 2008 housing crisis, and the recession. The Fed then left their interest rate at basically zero, at basically 0.01 or 0.1%, all the way until 2016. They started raising it again, and then they started lowering it before the pandemic actually even hit. But it's back at zero, and it's probably going to stay there for a while. So if the Federal Reserve interest rate is already at zero, other than going negative and paying commercial banks to take their money, what can the Federal Reserve do to increase the amount of money in the U.S. economy? Which leads us to the second lever of money control that the Federal Reserve has available to itself, and this is to buy government bonds. So let's think about this. First of all, if you didn't know, government bond is issued with different expirations. So you can buy Treasury bills, notes, and bonds. If it's a bill, it's 1 year or less. Notes are between 1 and 10 years, and bonds are a period of greater than 10 years. And I think they go up to 30-year Treasury bonds. And the Federal Reserve has auctions to sell these bonds, and I think there's always an auction on Fridays. And anyone can participate. You can go on their website, treasurydirect.gov, create an account, and buy Treasury bonds, Treasury bills, or notes directly from the U.S. Treasury. Anyone can do this. And how this is done is that the debt is sold at auction. People who want to buy government debts have to bid for it. So there's a competition for the price you're going to pay to purchase this debt. And how this works with determining a yield, we'll do an easy example and say that you're going to buy a $1,000 U.S. Treasury note that's going to mature in 1 year. And you're going to bid $950. Nobody bids higher than you, so that you are issued this debt. So how much profit are you going to make on this note after 1 year? Well, when it matures, the government is going to pay you $1,000. It's promising you $1,000 in 1 year. You're the one who determined how much you were going to pay for it by bidding on it at auction. So you were the best bid. The government is going to pay you $1,000 in a year. Your profit is going to be $50. So what percent yield are you getting on your money over this 1 year by issuing debt to the government? And it's 5%. Some people would be very happy with getting 5% on their money in a 1 year period. Guaranteed. This is the safest form of investment you can possibly do, buying U.S. Treasury debt. But what the Federal Reserve has done in the modern era is called quantitative easing, where they are the ones buying up U.S. Treasuries. So the government is issuing debt at auction like they always do, and the U.S. Treasury just shows up and buys that debt. That is how they are printing money. That is how they are increasing the money supply. This is money in circulation that didn't previously existed, and the Federal Reserve just pulled it out of nothing in order to outbid other people who otherwise would have been buying U.S. debt. And the Federal Reserve has not been holding back. Their guns are literally infinite ammo, and they are buying up all the bonds right now. U.S. Treasuries are a very safe and secure asset, and there's lots of people in these uncertain times who would like to be buying them, but the Federal Reserve is basically outbidding everyone. They are willing to go to the lowest price in order to guarantee they're the ones buying up all the bonds to increase the amount of money in circulation. And if we look at this chart over time of the Federal Reserve increasing the money supply, they've basically gone nuts the last year and a half. So they were at about $4 trillion at the beginning of 2020, and it has shot up to 18 trillion. I mean, this graph could be a couple weeks or a couple months old as the Fed continues buying government debt. So normally inflation should be about 2% a year. That is indicative of a healthy economy. What has people concerned about this rapid increase in the money supply is, what is that going to mean for inflation? It's pretty obvious. Now, going back to the U.S. Treasury yield charts, U.S. Treasuries got as low as 0.5%. What does that mean given the example I showed you earlier? What that means is that the Federal Reserve is bidding around $995 for a one-year note that's going to expire in 1 year. Now, obviously, for 10 years, there's this coupon rate where you're being paid interest semi-annually. The formula is a little bit different given that factor. I want to keep this simple for you guys. And to get a 0.5% yield, you're basically only making $5 a year on a $1,000 investment. Pretty meager, pretty unattractive, which is what is forcing other people who would otherwise be buying U.S. Treasuries into other areas of the economy. And the first place that maybe fund managers or large investors would go is dividend stocks. This chart you're looking at is the dividend yield of the S&P 500 versus the 10-year Treasury yield. If you can't get your 3, 4, or 5% on U.S. debt, U.S. Treasuries to beat inflation, is the stock market now a more appealing option? And that's exactly what's happened since the pandemic hit. As the Treasury yields went down to 0.5%, well, if you can buy a dividend-paying stock that pays 2% yield, you're beating U.S. Treasuries by 4x now. So this is what is causing partially the stock market to become so overinflated, because large investors, large institutions, foreign governments investing can't beat inflation with U.S. Treasuries. They're being forced into the stock market, and it is really appealing to go after dividend-paying stocks like Coca-Cola, Johnson & Johnson, ExxonMobil, whatever. If you can buy today at a 2% dividend rate, you're basically locking in that 2% on your cost basis over the next 10 years. As long as the company doesn't go bankrupt, and in 10 years you can sell your stock for what you paid for it, you're beating U.S. Treasury debt, which is pretty good. Another option for large investors is to go into corporate bonds. Are there corporations willing to pay a pretty decent yield for debt? And the Federal Reserve has already thought of this. The Federal Reserve bought up the corporate bond market once again to force investors out of this realm. Your money is not safe here. Go somewhere else is what the Fed is basically saying. So it's pushing money into these other investing realms, whether it be crypto or precious metals or real estate. That is why everything is at all-time highs, is because the Fed has vacuumed up the government bond market and the corporate bond market. So if you're one of these other large investors or foreign governments or whoever, you're pretty annoyed. You're pretty annoyed that you can't just buy U.S. Treasuries like you always do, because it is the safest investment if you can beat inflation. But who is this good for? And this is good for small to medium-sized companies, small businesses looking to receive loans. If people can't buy corporate bonds or government bonds and they want a decent return on their money, they're more willing now. They have the excess capital to loan to a small business or to start a new company or to hire more workers to try and basically increase revenue in the short term as opposed to making an investment with that money. That is the ultimate objective of the Fed by increasing the money supply. That is why that's why inflation is going up, is because people have money and they're spending that money locally in the economy in order to try and get a higher return. So now that you guys know what exactly is happening, let me explain to you what should be happening, what the normal Treasury yield rate tells us about the economy. So if we go to, let's say the 1 year charts, the Treasury yield made a huge advance. It was down here at 0.62 and it got as high as 0.74 recently as of March 2021. And when financial experts are constantly monitoring the 10-year Treasury yield rate and it's going up, that's actually a good sign for the economy. If the yield rate is going up, fewer people are showing up at the auctions to buy government debt. They're not bidding because they think they can make a higher return on their money elsewhere. So when the yield rate was going up between November and March, everybody was getting vaccinated, the economy was reopening, everybody was thinking to themselves, hey, the pandemic is over, we're going to get through this, I don't want to buy. There's still normal people at these auctions, normal institutions, investors, whoever, buying government debt. They're just competing with the Federal Reserve. And if they stop showing up, there's not as many people bidding, so the yield rate goes up. The bonds have to pay more in order to get more people to bid. However, since March, it's been going back down. What does that mean? It means that investors are now pessimistic about the returns they can make elsewhere in other markets, the stock market, the real estate market, wherever. They're pessimistic and they're once again bidding to buy US debt, which is driving the yield rate down. So when the yield rate goes up, people are optimistic about the economy. When the yield rate goes down, people are pessimistic. That's normally what the yield rate tells us, but with the Fed intervening and interfering with it, we no longer have the normal market forces for the yield rate. Okay guys, I hope you found this video informative. If you liked it, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.